Welcome back. In this video, we are going to work on a pro forma balance sheet. In other words, a projection, a forecast of the balance sheet. On the screen, you see that we have an income statement that was worked on before and was already projected for the year 2021. And these are the values. We have some notes that we need to pay attention to as we work through. And the idea is to fill these out. The reason why we have the income statement with us is because some of these in the balance sheet are related to levels of sales. In this case, accounts receivable, inventory are clearly related to sales. The more sales, if you maintain the same percentage of accounts receivable, it will be related as a ratio. Inventory, the more you sell, the more inventory you got to bring up or have or maintain. Not all of them, like the fixed assets, like property, plant, and equipment, and accumulated depreciation, they work on their own. And we will use the notes for that. Then other items like accounts payable, similar situation. As you sell more, you're going to require more from your suppliers. And if you have credit terms with them, your accounts payable will reflect that as an example. And forms of debt are typically not related, but other current liabilities, we are going to consider them also as associated with levels of sales for this example. What we have is information for the previous 2 years, and we're going to work on this number here. Okay, so cash and cash equivalents. For the purposes of this example, we're going to assume that the company wants to maintain the same level of cash, that's their healthy level of cash accumulation. So in this case, we're going to keep the same levels of cash from the previous year. So I got the equal sign and I selected that one there. So we're going to keep that one the same. We looked at the notes and there's nothing there stating that we're going to change our cash balance. No problem. Now for accounts receivable, we want to see the relationship between the accounts receivable of the previous years and the sales of the previous years. So let's look at, let's see what that looks like. So I do the equal sign to start the formula. I'm going to take the accounts receivable of 2020 and I'm going to divide it by the sales of 2020. Let's make that a percentage with a couple of decimal places. All right. Now, this one I can get away with dragging it. So I can also then do 2019, accounts received 2019 divided by the sales of 2019. And let's write average here because we're going to start getting the average of those 2 years to use it for our projection or forecast. Now, previously I have shown how you can do it through this menu here. Let's do it a different way. I can start the equal sign and start typing the word average. And you notice it's going to give you some list of selections, what you might be looking for as a function. In this case, we have average. Then I can click on it and it tells me a little definition of what it does. And now it's ready to start receiving the numbers to input. So I can do this, select the 2 that I want, and I'm going to close it with a parenthesis, and it's going to give me the same effect. Okay, so now here for the projection, I can take the sales of 2021 and multiply it with an asterisk as a symbol for multiplication with the average that I just calculated. And that is my projection for accounts receivable based on sales of 2021. Let's do the same thing for inventory. So I'm going to equal sign, take the inventory relationship with the sales of the same year. So inventory 2020 divided by the sales of 2020. Let's go ahead and make these all percentages as well. I can just, in this case, I'm going to copy and paste to use different features. And if you notice, and moved it to the right year. And then I can drag this down like that. And it's going to give me the same average, the same function using the ones down there. So as you move them or dragging from cells, it will move the formula with it. So I can go ahead and equal to the sales of 2021 multiplied by the average inventory percentage based on sales. And that's our forecast for that. Now, total current assets, no need to forecast. All we do is add these three. So I have this here where it says auto sum up here. I can just click on it. And notice that it's guessing that I want to add everything with a number above it. But we don't want the year there. So let's do that again so you can see actually. So I can just grab it here and shift it down or move it down one so it only includes the ones that I want. G3, which is G3 to G5. That's the way it looks like with a sum function. Sum meaning it's going to add it together. So that is our total current assets. Now, for plant and equipment, unless you fall outside the a range of sales, you're not going to need plant and equipment changes based on sales. But you still need to do replacement or expand a little bit, that's fine. But it's not going to be related to sales. It's going to be related to, in this case, the notes that we have. We do know that the net addition to plant and equipment was 50, so it was an increase of 50. It was an addition, positive number. So all we're going to do is take the previous year of plant and equipment plus, we're going to add it to that 50 increase. And that is our projection based on the information we have. Accumulated depreciation. Well, the additional plant and equipment was 50. This is 1,000, so 50,000. And they say it's going to last for 10 years. So this here is an additional depreciation. And since it's not specific, we'll assume straight line. We take the 50 and divide it by the 10 years. And that gives us the 5. So we have is an increase from the previous depreciation of 5. So we take this accumulated depreciation plus the 5. However, we still got to count for the 20 that was going on every year. So we're going to approach this a little differently instead of just adding the 20 of the previous year and the increase of 5 and the previous accumulated. That would be the step by step. But the straight way to do it is we take the previous accumulated depreciation and add the 25 that we already projected before. We already projected that the depreciation is going to be 25 is going to add to the previous year, which is, as we said, the 20 from the previous year plus the new 5 and the accumulated from previous year. But that's already given to us here, the 25 together. And now that's our forecast for accumulated depreciation. Now, net fixed assets, no need to project it because we have the total of plant and equipment minus the accumulated depreciation. So the value of your fixed assets net of depreciation in the projection, the forecast is 385.80. So total assets, all we do is take the total current assets plus the net fixed assets. And that is our projection for total assets on the upcoming year. Now, let's work on these here, the other side of the balance sheet. So accounts payable, as I mentioned before, is related to sales. So we're going to look at the relationship between accounts payable and sales level by dividing the accounts payable by the sales of the same year. go ahead and do this. And then I can also just drag it and it'll give me the same formula. Accounts payable divided by sales of 2019. And I can just copy, paste, and it gives me the average of those two. And I go through the same process, take the sales of the income statement, the projected income statement, multiplied by the average percentage, and that is our accounts payable projection. There's no information on short-term notes payable to have changed, not in the notes, not in, and they're not related directly to sales. So we're going to assume they're going to stay the same from the previous year. Other current liabilities, we will go through the same process. Start the formula equals other current liabilities divided by the sales of the year. I can copy and paste it, and it gives me the ones for 2019. And same thing here. I can copy, paste, and it gives me the average. Now we can use the sales projected for 2021 and multiply by the average percentage, and that is our projection for all the current liabilities. Total current liabilities, same thing. Just you can do the auto sum, check that is only capturing the ones you want. Hit enter, and that is our total current liabilities on the projected or the forecasted year. Long-term debt. There is no information to let us know that there has been any changes in long-term debt. So we will keep it the same as the previous year. So what are total liabilities? We take the total current liabilities plus the long-term debt. And that is our total liabilities. Now, common stock. At this point, up to this point, there's no information letting us know there's going to be any changes in common stock. So we're going to equal it to the previous year. Now, retained earnings, that's a function of the net income of the income statement and if there were any dividends paid. So we need to find out first the retained earnings for the period so we can add it to the total accumulated retained earnings. So we have this information down here. It shows us that there was a cash dividend paid to shareholders of $33.06. So in order to calculate the retained earnings for the period, we take the projected or the forecasted net income for that year. We're going to take away, subtract the dividends paid. And what's left over, it's our retained earnings. So what we do now is here, we start a formula with the equal sign with the retained earnings of the previous year. And we add the retained earnings for the forecasted period. And that is our retained earnings. So for total shareholders' equity, we take the common stock plus the retained earnings. And that's that. For total liabilities and owners' equity, we're going to take the total liabilities plus the total shareholders' equity. And now we have forecasted that piece. However, this is something you always have to pay attention to, and this is normal. What happened here was that total assets is supposed to be the same as these two together, but notice there's a difference. So now that's where discretionary financing needed or additional funds needed, there's many ways to call this, comes in play in order to make the balance sheet balance. What we're saying is like we need money somewhere. In this case, let's first find out, are we on a deficit or are we in a surplus? So when I take the total liabilities and owner's equity minus the total assets, I get a negative number, meaning we are in a deficit. So we need extra financing. In order to keep this example a little simple, we're going to assume that the extra financing needed, the discretionary financing needed, is going to be done through issuing equity. It can be done through also long-term debt, for example, or a combination of both. However, if it's done through debt, then that requires several extra steps, because when you increase debt, interest expense is going to go up, changing the projection of the income statement over here, from here on down. And then what it does, you got to do a series of cycles of increasing debt until you get the right amount here. But to keep this example simple, we're focusing on the items on the balance sheet. In order to make it balanced, we're just going to say they're going to issue equity. And all you have to do is for the same amount here. Hold on 1 second. So one zero belongs there. Okay. Now, if it's negative, it gives us a deficit. So we want to issue that much to bring that cash flow in of 2591. And then our discretionary financing needed after that zeroes out. So we're good. So what we have to do at this point is this original projection we had on common stock, I'm sorry, meaning that now we have information telling us that that's going to change. Before we didn't, but we couldn't change it because we didn't know what was going to be the difference. Now that we know the deficit, what we do is we take that number, we're going to add that issue of equity. And when you do that, now your discretionary financing over here becomes zero. This we just get out of the way so it doesn't confuse anybody. And this is your new updated common stock on the balance sheet. And now notice that they're both the same. And at that point, you're done. We have balanced the balance sheet through equity. It doesn't have to be equity again. It can be done through debt, but that requires then changes on the previously income statement, and you do several rounds until you get the right amount of debt. You have to increase it by. At that point, we will discuss that in a more elaborate example in the future. But this is the one simple way to do a forecast of the balance sheet based on the forecast of the income statement and the last step of making it balanced. We will stop the video here and see you on the next one.